Welcome to the Flex Forward podcast, where grit meets growth. With your host, Nick Espanet, bringing you stories of resilience, reinvention, and the real climb to success.
Well, hey, folks, welcome back. We're here again today with our good friend, Nick Espanet, zooming in from beautiful Fort Worth, Texas. And you already know, Nick, you're part of the whole Flex Forward family. But just to give you a reminder, in addition to being an amazing podcast host, Nick is also a very accomplished real estate investor, and he focuses on apartment buildings. So, Nick, great to have you. How are you doing, my friend?
Hey, Dave. Thanks for having me. Glad to be on and be the interviewee and change it up. But now going well. Just finished up a little family vacation, so
Nice.
Back kind of getting in the grind this week.
That's right. So you get to be the guest on your own show here, my friend. So I'm going to ask you some questions. Let's talk about, first of all, maybe like a little bit of a market pulse. So first of all, remind people, what different real estate markets are you invested in these days?
Sure. So I live in Fort Worth, and right now we have a multifamily or apartment complexes in Arlington, Texas, kind of in the middle of DFW, one in Houston, and then we have 4 properties, a little over 800 units in Abilene, Texas. And for people not familiar with that, Abilene's about 2 hours west of Fort Worth. Its population's 125,000 or so in the city.
Yeah.
The metro's probably 150. But it's just been a nice little market out there.
Okay, well, let's talk about that. So you're a big fan of Texas. I can understand that. You're in Dallas, Fort Worth. You've got some properties there, but Abilene seems to be kind of your baby. So tell us, maybe let's take a deep dive into Abilene. What do you like so much about that market?
Well, I'll start kind of the beginning, how we ended up there. When I first started looking at multifamily about 10 years ago, we kept bidding on stuff in DFW, but kept getting outbid. So my business partner and I said, well, what can we do to where we can have be a little more competitive? So we started looking in Texas at towns of a population of 100,000 or more that had at least 3 economic drivers with positive job growth and positive population growth. And so that was, narrowed it down to about, I think, 7 or 10. And we started looking, and Abilene was the first place that we made offers in a few other places, but Abilene's where we actually were awarded the deal. And we've since had 6 deals there, because now we have economies of scale. When there is something in Abilene, we can usually run it, just because we have we can share staff, we know contractors, we can run it more efficient than a lot of other folks. And so if which may or may not be fair, but we can come in with lower expenses, and we know the areas too. So
you guys have become the big fish in the little pond, so to speak.
Correct. Yeah. Exactly.
Well, tell me some more about those economic drivers in Abilene. So you mentioned it had to have like at least 3 major industries and positive population growth and all these different things. So tell me about that for that particular city.
Well, and the thought is, if some of these smaller town communities may only have 1 economic driver, and if something changes and that goes away, it can really adversely affect the area. So Abilene has its biggest private industry is healthcare. Abilene serves as a medical hub for 19 surrounding counties. So in the more rural areas of West Texas, you may have one large city where all the surrounding counties come in for their specialty care, because the smaller counties are not going to have maybe the MRI machine or some of the expensive equipment. So that was one. Abilene has a large number of big employment in medical. And then next is education. And Abilene has 3 colleges, 3 universities. And then after we started buying there, Texas Tech, one of the larger public universities, opened up a nursing, and I think allied or biomedical science or something. So they have a satellite campus there too. So quite a bit of education. And the third is a military base, which military bases can be a little concerning if the government decides to downsize them. But this isn't one, it's an Air Force base. So unlike Marines or Army, where a large number of people can be deployed and you can lose a lot of your tenants quickly, Air Force, a lot of their stuff is run from that area. And then also the odds of dyes being shut down. It's one of the hubs for the new stealth bomber. So that the government has spent a lot of money on refitting that base to take care of that bomber. So most likely it's not going to go anywhere. I mean, the government can make crazy decisions, but it's unlikely they're going to.
Oh, worst case scenario, you've got some other industries that are backup, right? Which is why you're not looking for one factory town.
Yeah, and a lot of people think of West Texas as being fossil fuel dependent, and Abilene is very little dependence. If you look at the list of their largest employers, like the first oil and gas company was upper 20s, low 30s on the number of employees. So very little oil and gas dependence in Abilene. Unlike you go a little further into Midland and Odessa and some of those, I mean, they're probably 90% of their industry is fossil fuel, which it can boom.
So what's going on in Abilene in 2026 that's kind of exciting?
Yeah, no, currently, and we I don't know if lucked in or that one of the first data center that was being built, Trump announced it, I think last February on a press conference that they're building a data center that brought between 5,000 and 7,000 construction jobs for anywhere between 3 to 7 years. We're trying to get different reports. Well, that one started, and then another one started. So right now we have about a 3-month wait list on our properties. That combined with no new properties have been built in Abilene in about 2 years. What happened in the major metros, and when money was cheap in 22, 23, is there's a massive overbuilding. And, DFW, Houston, Austin, San Antonio, tons of new properties were built while the population was moving in post-COVID, and construction dollars were cheap, less expensive to come by. So those have been flooded with oversupply. Whereas my stuff in Arlington and Houston, we're actually lowering rents or having negative rent growth to keep full. Abilene, we're getting double-digit rent growth.
Wow, that is
just because
awesome.
of data centers and the low supply.
Fantastic. Well, thanks for giving us that kind of market update there, especially for Abilene. Let's take a little look at your portfolio of apartment building communities. So remind me again, Nick, how many different communities
right
are
now
you
we have 6 currently, and I actually made sure I got my numbers right. So it's 1,200, we're about 1,230 plus units total across, and then we have 800, just over 800 in Abilene, and then another 430 or so in between Houston and Arlington.
So what's something interesting that's going on in your portfolio right now? Is there anything kind of
well, with
either good, bad, or ugly going on right now?
No, the market is the multifamily market, or real estate market in general for the last couple of years has been challenging. Just the stuff bought in 21 and 22 was kind of at the peak of the market. A lot of those properties are 20 to 40% below the value that we paid for them at that time. So it's just trying to keep those alive until rents start growing again. But in Abilene, with the data centers and just the demand, we've had a property bought in 19 and one we bought in 20 that we've been waiting to sell, but the market is hot now. So we've got 2 that are under contract, should close the sale in mid-August. And so it's exciting. We're going to meet or exceed our projections. We're giving positive and outperforming our projections on both those. And so that is exciting in a time when people, you're hearing of a lot of deals being foreclosed on or selling for losses.
That is very exciting. Congratulations. Yeah, because a lot of your compatriots, a lot of your associates who are in multifamily real estate investing, apartment buildings, they're struggling in those bigger markets like the Houstons and Dallases, et cetera. So that really speaks to how smart it was, how fortunate it was for you guys to get into Abilene. Good stuff. Sure. Okay, so Nick, we've been talking a lot about investing in apartment buildings, what we call multifamily properties. And I think the primary way you do that is through something called a syndication. Is that correct?
Right.
Well, can you do me a favor? Can you walk us through what exactly is a syndication? How does it work? How does it benefit you? How does it benefit your investors? Just kind of walk us through that process, please.
Now, so a syndicate, that's how we've done all of our properties. So ask the syndicator. I go out as the lead GP.
What does
Or
that mean?
one of
What's
my
GP?
a Jeep general partner, and then we have limited partners, and kind of get into those as we go. But the general partners are the ones that are they go out and find the deal, they put the deal together, maybe start with the initial earnest money down, put the risk, then time in, and we're looking for deals, and we target our offer. We want to give our investors an 80% or better return on a 5-year hold. So for a round number, say somebody invests 100,000, we want to give them the original 100 plus 80,000 back within 3 to 5 years. So ideally, or we're looking really trying to target 100%. So the original plus a double or 100,000. But
Which,
so
which
we'll
comes
go
out
out
to what kind of range on an annual basis? What are you kind of
well, and with about anywhere we're shooting for about a 6% average annual cash flow. You get most of it on the sell. You get
Right.
most your pop at the sell. But we are giving out. One thing we're targeting is 6% or better average annual cash flow. Now, if we're buying something built in the 2020 or newer, 2010 or newer, it's going to have less cash flow just because you're paying a premium. But if we're buying older properties, we're setting our offer price that we want 6% or better average annual cash flow and an 80 to 100% total investor return on a 3 to 5 year hold.
Right. So looking over the annualized return on their investment would be
15 to 20%.
15 to 20%.
Yeah,
Okay,
when we sell.
Okay, good. So there's the general partners, that's you guys. You're finding the deal, getting under contract, putting up the what you call earnest money deposit, which is, a deposit.
It's six figure. You're looking at usually 1% of the purchase price.
Right. Okay. So a significant amount of money. Okay. So that's the general partners. You kind of find the deal, manage the deal, do all the stuff. Then what? Who else is
General partners also sign on the loan.
Okay.
So we are the loan guarantors, but then we bring in LP. Say, let's just throw
What's
around
an LP?
A limited partner. That's the investors or the common equity. So let's say we're buying a $10 million deal. We get a 70% loan to value. And
So a mortgage, basically.
like mortgage. So, lender's going to bring, and I'm not even going to count in CapEx because I don't get the number. Let's just go with that. So the lender will bring 7 million. We need to bring 3 million to buy it. So as LPs, we're usually putting 5 to 10% of, I'm sorry, as GPs, general partner.
Oh, you froze up on
Of
there,
the
Nick.
I'm doing them right. Yeah. Of the 3 million. And then we go out and raise that money through friends and family, which is, you can do it with only friends and family through the SEC regulates how you
Let's
do
not
it.
get into the weeds.
Yeah.
Just
but so
tell us what it. So
Yeah.
you froze on me there. You're explaining the general partner brings how much to the table?
about usually 5 to 10%. We shoot for 10%. So on a
So
$3
under
million
those 3
raise,
million, you general partner would bring in 300,000.
at least 300 of
Got
our
it.
own money to put in, and then we raise the other 2.7 million through friends and family. Now, and as an LP or limited partner, you have no exposure. You're not on the loan. If if there's a suit or anything that happens, you're not part of that. You're not exposed. Your only risk is
You're
your
not getting
investment.
sued.
You're correct.
Got
And
it.
so, but for that risk, as GPs, we take a 20% override. Generally, I mean, when I first started my first deal, I did a 10% GP override just because we wanted to prove ourselves out. So we took a
Yeah.
smaller, and we do a 2% asset management fee. So we get monthly 2% of the income, and then on any profit, we get 20%. But we don't get our 20% until the LPs are made whole. So same
Limited
scenario, you invest 100K until you get your 100K back. That's when we start getting the 80-20 split.
All right. So you've got, let me see if I got this right, just to summarize it. You, as the general partner, you go out and you find an apartment building that looks like a good deal. You get it inspected, you do your due diligence, you do all the legal paperwork, you do, lots of expense on inspections and whatnot and studies and et cetera, et cetera. And you get it under contract. You put up some cash as an earnest money deposit. Then, As a general partner, you're out there talking to the bank, getting good financing for the property. They'll probably loan up to 70%. So in this case, $10 million property, you can probably get a $7 million loan, or common people would call that a mortgage, right, on that apartment building. But you still got $3 million you got to come up with. As a general partner, you've already put up earnest money and all that stuff, but you're also putting in at least 10% of the money, the capital that's required. So you're coming in with at least $300,000. So you got some serious skin in the game. And then you still have to raise about 2.7 million of capital to buy to come up with a total 3 million. That's where you go find investors, and those investors are called limited partners. You're the general partner, they're the limited partner. The limit means that they're limited by how much exposure they have on this property. That if something goes sideways, they're not the ones getting sued, you're the one getting sued. Is that pretty much how it works?
Correct. They're really not buying. What they're doing is they're buying shares in the entity that's buying the property, but they get all the benefits of the real estate. They get the depreciation, and some of the tax benefits. We won't get into the weeds on that. That pass through, and so they get a lot of the benefits. But I mean, really, their only risk is their money they're investing.
Got it. Okay. Very, very good. So they get all the benefits of investing in real estate without the headaches of the risk, of the legal risk, nor do they have to deal with the tenants or the toilets or leaky roofs or any of that.
And just something we send out monthly newsletters. We share our financials monthly through a portal. We give a little, about a page of what's going on, half page to a page, depending on how active things are about what's going on. Our goal is to talk. If anybody has a question, we get back with them within 24 hours. It's not, I may not have the answer, but I'm at least going to call you or communicate with you. Hey, I don't know. I need to ask our property management company or somebody, one of the on-site team. What I need to research this, but we will get back with you. That's been a goal from day one, is to good, bad, or ugly. And we've had properties that are challenged through COVID, but we try to present, here's what's going on, not try, we do. Here's challenges. Here's what we're doing to improve them. So
that's good, because it's easy to have newsletters and get the news out when it's all good news, but it's not so much fun if the news isn't always good. But transparency is very, very important.
Yeah. And some people do it quarterly. We do monthly distributions and updates. Some will do quarterly. Something, if you're looking at this with other operators, just ask what their communication plans are. I know some people have been disappointed where there's a group that only sends out information once a year and they don't share financials. Which, if you're getting a check every month, I don't think most people care. But when the market's been more challenging the last couple of years, they've not been happy of the lack of communication.
So, Nick, we were talking a little bit off camera before we started the recording that we want to kind of do a deal spotlight, and you've got one. We got a couple right now that you've got on the market. Maybe let's pick one of those and walk us through that deal. Kind of tell us the story of that property. So, which one comes to mind for you?
Yeah, at Curry Junction, it's a 228 unit property in Abilene that we bought in August of 2019, and it was built in the mid 80s. I went in there were four of us as general partners on that one, came together, worked together. One of the guys I've done almost all my deals with, but we bought it. We started out with
So just for a second here, maybe what role do different, like a lot of people would wonder, why do you need more than one general partner? So maybe explain why you
Good question. Well, as general partners, our net worth needs to equal the loan amount. So we need to bring in partners to equal, like the other deal we were talking about. The loan was $7 million. The net worth of all the general partners needs to.
So what about this one, this Curry Junction one?
Correct. I should know the price we paid for that one. Hang on, I can tell you real quick. Curry there. We paid in the mid-teens for that one. It's valued in the mid millions.
What is that? Sorry, give me a number.
You know what? I don't remember off the top of my head. So
Mid
let's just
teens, so
say
something around
around
15,
16 million, I believe.
16 million. Got
And
it.
it's valued in the mid to low 20s now.
Nice. Yeah.
I don't want to give too many numbers since we're under contract, and
Got
I'm
it.
going to be
Okay, fair
vague
enough.
on those numbers. But and just in case something we need to move on to somebody else. But so that one we bought in August of 2019. We came in, like I said, we needed five, another guy, but he wasn't that involved. Four of us came together, like I said, put the earnest money up, paid tens of thousands of dollars in inspections and loan fees. So we're out of pocket significant six figures, before we start raising money and exposed on that deal. So we bought it in 2019. We repaired all the dry rotted wood, painted. We kept the same name, but we repainted. The colors were really faded and old, so we came in with more energetic, modern colors. The somebody had converted part of the office and main room into the fitness center, so it's just a weird kind of wonky layout. We wanted to make it back into more of a sitting room, a study. There was a small laundry room, but every unit has washer and dryer connections, and they were making a couple of $100 a month in laundry, so it wasn't even hardly worth the electricity and water expense. So we closed off the laundry room, made that into a fitness center, brought the office and I've gone blank, not the
Lounge.
conference room.
Conference room. Okay.
Yeah, back into like a big TV room. And we were going to have, it was in March of 2020, February, March of 2020, we were going to have a Final Four of basketball watching party. Well, COVID shut everything down about that time. So that, and we had a property management company that just wasn't performing. And so, we started dipping with this management company. We could see what the other properties in the area were doing. So we ended up replacing them about 4 years ago. So late 21, we opted to go with a new property management company that already had a big footprint. They managed 4 or 5 other properties. So that gave us more scale. And so this property is ever since, and we've not been below 92, 93% occupancy. Now we're in the high 90s. And so, whereas a lot of the rest of the state right now, most deals that are selling are distressed. We have this deal is functioning, and we projected high 70% return to our investors, almost 80%, and we're going to more than double that. Double.
So why did you guys pick this property in the first place?
One is having a relationship with a broker that we had gotten to know out there a little bit. He showed it to us. We looked at it. We get the deals. We underwrite a lot of deals that we never go forward with, and we plug the numbers in, and it looked like a return that worked for us. And so
and what was the return going to be based on? Was it going to be based on doing these improvements on the property?
Correct. We would come in and take some of the classic units, convert them, upgrade them, because we go out and shop the comps for other properties and see what they're getting for an upgraded unit. And we're like, hey, this property up the road is getting $100 more by resurface counters, backsplash, wood look vinyl floors, two-tone paint, whatever it's kind of in vogue, black appliances or stainless steel appliances. And so we're like, these guys are doing it. We can come in and do that. The seller usually has run out of capital. They don't have the money to put that in, but we could come in, raise the CapEx to do these upgrades.
CapEx, plus, what does that mean?
Capital improvements. Like I talked about, we repaired all the dry rotted wood, painted it.
So basically, you took kind of a rundown property and brought it up to snuff, kind of brought it up to current market value. What impact did that have on your average rents?
We went up about $100 to $150 at the time.
Okay.
We were able to get that, especially once we changed property management company and just started screening tenants better, had improved. But it's it's coming in, putting a better product out there that the prior owner, they weren't doing a bad job. They just had kind of hit their level. The goal is we want to upgrade about a third to half the units because we want to leave meat on the bone for the next buyer to come in and hit some of the classic units. And then some of our initial upgrades are probably getting tired. And so, it's just making it a little more presentable property, running it more efficiently at that point.
And what impact does that have on the total value of the property? If you're able to, like, I don't know, were you able to raise all of the rents by an average of $100 a month?
Not just
Or
the
some of the
upgraded
rents?
units, and then
Okay.
slide upgrade on the non-upgrades. Now the beauty is we come in with a capex money on the front end. We spend that; it doesn't hit our NOI, our net operating income. So I'll get into how you value. Let's pause, put a pin in that. So on an apartment in the U.S., if you buy 5 units or more, you're valued on the cap rate, your NOI divided by the cap rate. If you buy a
You're
duplex,
getting very technical on us here. So
Well-
dumb it down to everyday man
so
speak.
on a 4 unit or smaller, your property is valued on comps. So you could buy
Comparables. What other properties
yeah.
just like that are selling?
other properties in the neighborhood. You could make it the best looking property in the city, get a tremendous rent, but when you go to get a loan, the bank's still going to only value by comparable properties within a certain distance.
Okay, so let's talk about the kind of properties you guys do instead.
So we buy multifamily, 5 units and bigger. The net operating income is your income minus your expenses.
So your profit.
The profit. And so that's how they value properties of banks. They take that divided by a cap rate, and cap rate can get confusing because it can be different from different locations, but it's an equity multiple but you have control over the NOI. We can either lower expenses, increase income, which is going to make the NOI higher, which is going to make our value higher. That's where coming in.
So
doing
the bank
upgrades.
looks at an apartment building kind of like a business, and it values it on how profitable it is. Is that
Correct.
kind of a summary of it?
We can do forced appreciation by doing those upgrades, getting $100 more per unit, and you multiply that times 50 units and then divide it by a cap rate. It's significant. It could be millions of dollars.
Give me a ballpark. Like if you did
Just let's in Abilene we wouldn't have a 5 cap, but I can do the math. A 5% cap rate is a 20% equity multiple. Say you do 50 units at $100 is $5,000.
yeah.
Divided by a 5
So
cap
$5,000 a month.
a month. Yeah, let's just do it per month, because then we can do that. Multiply it by 12 is 60,000 a year you're making, and divide that by a 5 cap, which is low for Abilene, but the math's easier. It would give you 60,000 be 1.2 million in value increase.
Right. So this is what's so huge that most people don't understand is increasing the rent $100 a month on 50 out of the 228 units in that property. In the bank's eye, that makes that property worth $1.2 million more than it was before. That's where the money is really made. That's how you're able to take that property you bought in the mid-teens and now it's worth in the mid-20s.
Yeah.
Because not because of natural market appreciation, because you've increased the profitability of that property.
Correct. And just think about that. We paid 16 million for it. We raised 5 million and the bank brought the other 9 to it. So once we increase the value by 5 million, we've doubled our investors' money. We don't have to increase. That's the beauty of using leverage over paying. You could go pay cash for it, but to double your money, you got to increase the value 16 million. But if you get a loan at 75%, you only have to increase the value of the equity you brought to the table.
Yeah, right. So again, what was the example there? It was 5 million guys
5 million.
into this?
So yeah, and we've gone
5 million. You and your investors, your limited partners, brought in this deal, and by doing some of these tricky things you're talking about, it's a lot easier to increase the value of the property by 5 million than by 15 million, right?
Correct.
So that's where you get your return.
So that's the beauty of it, is that leverage helps you do it. And our goal is to sell in 3 to 5 years. We've held these a little longer so our investors can take their capital. Hopefully we have another deal around that time they can invest with us or put it somewhere else and grow it. Because it's an fairly illiquid. You can cash out, but it's not easy, and it's whatever the market will pay.
Right.
But we're tying up significant amount of people, quite a chunk of money for 3 to 5 years, and most people want to get that back. Redo it. Now there are some people that buy generational properties and hold them for a longer period, but that's just a different not necessarily. I mean, I'm saying better or worse, but it's just a different path.
Yeah. Very, very cool. Well, thanks for kind of walking us through that
Yeah.
example.
Thanks for directing me, because I love it. I can get into the weeds on
I know. We'll
numbers
do that
and
another
technical terms.
So, Nick, as we're wrapping up here, maybe outside of business, what else is going on in your life? What do you do for fun? I think you just came back from a trip.
Yeah, we just got back from a trip in the Panhandle of Florida with my parents, my brother and his family, and all my family. So we had 18 people
Oh my
there, which now it was refreshing, great. You know, it's I love going to to me, the Panhandle of Florida is one of the best beaches I've ever been to. Just white sand, clear water, great places to eat and just hang out. You know, we eat out a couple nights. We cook at home. You know, this place had a massive table that we could fit everybody around. Just
Wow.
great.
So was this a big Airbnb place, or where were you staying?
Yeah, I mean they're off. They're not Airbnb, but similar. But it sleeps 28 people. The place we stayed in, and it's walking distance to the beach.
How long were you there for?
We were there Saturday to Saturday, so 7 nights. It's but it's and we even actually stopped in New Orleans on the way and ate. And New Orleans is a good place to stay for brief periods. It's as I've gotten older, it's not a place to stay for a long period. But we ate at a couple of good restaurants for dinner and then brunch, and then moved on. But love it, and getting just hanging out on the beach. We can fish, we can go out or just walk, bike. My kids are old enough now that we just let them just be back before certain time, and they pretty much are on their own. So it's
how many kids do you have, and how old are they?
I've got 3 girls that are 20, 18, and 14. We've been going probably for 17 years. When they're little, you've got to watch them the whole time, watch them in their water, and you still keep my eyes out when they're in the water. But it's also relaxing just to let them kind of do their own thing. We get bicycles; they can ride bikes down to their little towns and hang out, shop, have coffee, and do a lot of that stuff. So it's relaxing.
Very nice.
It's a blessing, yeah.
That's awesome. Well, hey, Nick, this has been a lot of fun. Thanks for the updates, and we'll check in with you again next month.
Awesome, Dave. It's always good to chat with you, and I appreciate you hosting me or interviewing me.
There you go. Yeah, exactly. Interviewing you on your own podcast. All right, everybody, take care, and we will see you on the next one.
Thanks for listening to the Flex Forward podcast. If you've got grit, growth, and a great story, visit flexforwardpodcast.com/guest to apply and join us on the show.